Myers, and I lead the distribution team at Pengana. Thank you for joining us for our first webinar in the series, which is an update with Anton du Preez, the Deputy CIO and Fund Manager of the Australian Equities Fund. Anton will be joined by Mark Christensen, an investment analyst on the team. To give a quick introduction for those who are less familiar with our business, at Pengana, our key aim is to offer our clients differentiated strategies which will add value to their portfolios. We have no Me Too funds in our business. Today, Anton and Mark will talk about the objectives of the Australian Equities Fund. These focus on the creation and maintenance of wealth for our investors. They aren't related to being a top performer in any period, nor are they related to the performance of the index. The composition of the portfolio is very different to the index, so the performance can be expected to be different too. They will also discuss some of the challenges and risks facing investors in the current environment and the approach the team has taken and continues to take to meet their objectives. Gents, over to you.
Hi, good morning, and thanks for the opportunity to present to you guys. So we'll start with the, as you know, the Pengana Australian Fund. We'll start with the investment team, and I just quickly want to, talk about that. So we've added a new member to the team, and this was really during the year we did an intern program for the first time, where we had 4 interns for a 9-month period. We were pleasantly surprised by the quality of that, and at the end of the day we made an offer to David Glasser. David is a qualified civil engineer, and he's also got a commerce degree with a major in accounting, so we are quite pleasant to have David in the team, a young guy with lots of energy. So if you can just move to the next slide. So this slide has been part of our presentations really from day dot since we started the fund. And that was really when Rhett and I started the fund. We asked ourselves, what do investors really want and need? And it's really to preserve and grow the purchasing power of the funds entrusted to us. And that's really done by 2 ways. Firstly, by capital preservation, and that's really maintained a real value of money in Australian dollars. And secondly, to generate a reasonable real return, which in our view was a risk-free rate plus an equity risk premium of 6%, which would maintain your real return. Now, by doing that during the past few years has really been non-trivial and really challenging, and that's really because there's been a dislocation between the risk-free rate and inflation. So historically, we thought that the risk-free rate is a very good proxy for inflation. But as you know, during the past 18 months, 2 years, interest rates has been at an all-time low, and that's really by governments and central banks trying to stimulate the world economy, by lowering the interest rates. If you look at inflation, you look at between 1.5% and 2%, and it all depends how you measure inflation, because it might even be higher than that, if you look at some of the effects of COVID. But essentially, you've got a risk-free rate of 0.1%, inflation of 1.5%, call it that. So you've got a negative real return, which is really the first time, in a long time that has happened. And we're very cognizant about that when we manage the fund, because at the end of the day, to preserve capital, to maintain your wealth and enhance it, you do need a return of inflation, plus the equity risk return. And we'll discuss that a bit later on, and in more detail later in the presentation. So if you go to the next slide, so this is really our performance, short-term and longer term. And if you look at 1 month, it was 3%, or it's 2.6%. This is up to August. Just for completeness, for September, September was a more volatile month. We were down 0.5%, and the market was down 1.6%, which was quite a pleasing outcome for the month as well. But I actually want to draw your attention really down to the last two lines there, which is financial year 20 and financial year 21. So financial year 20 included the COVID event. So if you look at the fund over the years since inception, it's always been, the fund behaved like in a down market, we would be down less than the market. And then when the market recovers, we would recover as well, but not to the same extent. And that's really due to the fact, the way we manage the portfolio, being more defensive, being in companies that generates cash, etc. So if you look at those, FY20, we were obviously down less than the market, minus 3.9 versus 7.2. But the one thing that I would say really surprised us in financial year 21 is how well on a relative basis we kept up with the market, given the defensive nature of our portfolio. So you need to remember that, there is a bit of a bifurcation in the market where, we never participated in the high multiple stocks, the tech stocks, some of the fintechs that actually doesn't make money, it doesn't generate cash. As Rhett would always say, if you look at our portfolio, it's much more toothpaste and toilet paper type of companies. So we were quite pleased on that combined basis, that we track the market. Next slide, please. So this is really the fund performance since inception. So as you know, we started the fund just post Lehman's. It shows you how well we timed the market. So if you look at the lines here, the dark blue line is the fund. The green line there is your RBA cash rate plus 6%, and that's really our benchmark, as I said, and that's the one that we follow and track every day. Then you have the ASX, all ordinaries, and the cash rate. So you can see in 2020 with COVID, we obviously underperformed that benchmark of ours quite substantially. But pre-COVID, the team was quite nervous about market valuations at that time, the ritzy multiples. And at that time, we had quite a high level of cash, combined with, we had insurance as well, put options. And we obviously never knew COVID is going to happen, but we were just very nervous during that time. So when COVID happened, the fact that we had insurance and we had cash actually gave us the opportunity to allocate capital. And I have to stress, this wasn't an easy time during that time. The fact that we had cash, we could deploy it. And the fact that we had the insurance actually wasn't just the fact that we had insurance, it actually made a psychological whole, because as you can imagine, you've got this down markets. It's very, very hard, to cross the abyss and allocate capital. So during that time, we allocated $150 million of capital. And if you, combine that with the previous slide where I indicated how we tracked the market on the up again, I think it's really because we were brave enough to allocate capital during that time to participate in a very strong market. So I'll pass it over to Mark now, who will discuss some of the issues in the market. I'll come back with the portfolio and also some stock analysis. Over to you, Mark.
Thanks, Anton. So, I mean, Anton's reference there, a time to be, to be brave throughout that COVID period. And those of you who have seen these presentations before, we put this chart up saying there is a time to be disciplined and a time to be brave. And when Rhett gave this presentation about 6 months ago, I think at that time he might have pointed out that it felt as though we were in the sort of the euphoria anxiety section of the chart. And if we sort of make that reassessment today to say, where are we, we might have nudged just a little bit further forward towards anxiety, but I'm not sure that we've committed ourselves yet to that downslope. The thing about this chart is that, as presented by an academic, and I can't remember, I think it was out of might have been out of one of the US universities, but you look at the chart and it sort of depicts it being a fairly linear progression, i.e. each dot is, say, 3 months apart exactly, etc. And that's obviously not how it works in practice. In actual fact, it could take, you know, multiple years to move from optimism to anxiety, and then it could take a matter of months to go from anxiety to sort of depression. And that's one thing that we're always very careful of. And when Anton said that we were kind of nervous ahead of COVID, I've now been with the team, I guess, for 8 or 9 years, and I'd go as far as to say it sort of feels to me like we've been nervous for the best part of that period. And I guess it's just the way that we operate. But it does feel like we are now a little bit more towards that anxiety level in terms of the party could be over in terms of the great COVID recovery, and people are starting to switch their minds now to a little bit, what do earnings look like in a post-COVID world? Once we revert to normal, so to speak, and how are equity market valuations positioned to reflect that reality? And I guess that's part of what we're going to talk about for the next 5 minutes or so. If I go forward here, I mean, this chart is one that we watch monthly, not because it guides our decision making, but if nothing else, it sort of reinforces what we suspect we're seeing in the market, and that is quite a strong bifurcation in valuations of the market as a whole. So what the blue shaded area, if you like, is the market as a whole, the ASX 200, and that's trading at about 16.9 times at the end of August. It would be just a little bit below that now today, but within that 16.9%, which you can see in the context of the last 20 years is elevated, not mind-blowingly so, but it is elevated. Within that, though, there's 3 very different pictures. You have banks trading on about 16 times, which is relatively expensive, but I guess the environment at the moment is quite supportive for the banks. You could possibly justify that being the case. You have resources actually starting to look incredibly cheap, and having derated strongly over the last little while, and a big part of that is because of the commodity prices making their earnings forecasts look very, very strong. So they actually look quite reasonably valued. But then the rest of the market, inverted commas, which is your industrials, ex your financials, and ex the resources, looks mind-blowingly expensive at over 30 times earnings now. And that's not just one. I think I haven't got the standard deviations on this chart here, but it's a couple of standard deviations above the mean. And this is where we see a lot of those tech stocks that Anton mentioned. But it's not just tech stocks. I mean, it's growth stocks in general, and there really are some very high PE multiples being asked for and being paid in the market, and then that's something that makes us very very nervous. Something that we're very conscious of. If I move on to the next slide here, part of what I guess actually tells the story or explains that sort of trajectory in valuations is this long-term history of the long yields. And again, for those of you who have seen these webinars or presentations before, you'll recognize this chart. We're not going to go through a history lesson here, but the point really is, if since certainly 1980 or since that time, we've had about a 30 or 40 year period of effectively a one-way trajectory. There's been fits and starts, but there's been a great tailwind for what has now, I guess, been 2 generations at least of investors have really been operating with interest rates sort of a downward interest rate cycle, and we are now at levels which is almost at 30-year lows. And the thing about being a manager of long duration assets during that time is that as I said, this has been the great tailwind. The value of long duration assets goes up as interest rates come down, and we consider that from where we are now, it's hard to see interest rates being able to go lower than what they are. Certainly they can't go materially lower than what they are. So at very least, that tailwind looks likely to be disappearing. And then you start engaging in a discussion as to say, well, what if we're actually beginning some sort of an interest rate upcycle here, and and how long might that be? And that's that's a scary thought for a generation who hasn't dealt and hasn't managed money in that environment, and who's going to have to do so with, you know, as I said, with certainly without the tailwind and possibly with that headwind. So that's a context on the impact of long duration rates over the last little while. When we look at the current market, and we sort of thought about this presentation, we thought, you know, why don't we just give a bit of a snapshot, and this has come about since the end of reporting season as well. So a couple of these themes have surfaced, but we just thought we'd discuss what are the current issues in investing in today's market. And really, you know, you could sort of say there are 10 or 12 or what have you, but we're just going to focus on these three. So the three issues really are that low interest rate environment we've just been discussing versus the inflationary risk we see in the system. The second one is forecasting error associated with COVID over the last couple of years and the ongoing lockdowns. And the third one is supply chain and inventory disruptions, and that's across all sectors really. So on the interest rate side, we consider, you know, what I just said there a moment ago, that long-term trend of declining interest rates being behind us, and that tailwind, but also what has been the impact of interest rates on valuation of long duration assets. We know it's supportive, but if you consider the specific types of equities that benefit most from low interest rates are those that are not necessarily making a whole lot of money now, but are forecasted to make a lot of money in the future. A low interest rate environment will, in a discounted cash flow valuation model, will make those future earnings look a lot higher in today's money. And so low interest rates is very supportive of business models that have a lot of their profits being made in the future. And that's typically your growth category, you know, to state the obvious. But there are a lot of companies out there right now trading on very high valuations that are not making a lot of money now, but people are very excited about their future prospects. And those are areas that we typically have not played in the past, but we're particularly wary of at the moment. The other impact is of course what Anton alluded to at the start when we think about low interest rate environment, is the fact that we do see a lot of inflationary pressure in the system. I wouldn't go as far as to categorize ourselves as you know, inflation bulls. We're not economists or sort of take those big macro views necessarily, but we do recognize the pressure in the system. And as Anton said, certainly at the moment, with, you know, long duration interest rates, you know, near zero, and inflation running about 1.5% or 2%, we are looking at a situation of having negative real rates, and we have to ask ourselves, how sustainable is that, and what impact does that have on our investment decisions as well? The second bucket here we look at is forecasting error associated with COVID and ongoing lockdowns. So we spend a lot of time with our financial modeling doing bottom-up analysis, and we build models for, you know, we've got models for for many, if not most, of the ASX 200. But we don't build our models for a nice, you know, sort of catalogue of historical performance of the ASX. We build models so that we have can establish some sort of a true base from which to forecast future cash flows, and it's those future cash flows which are important to us. And we're not alone with that. Obviously, the market's doing the same. This becomes problematic when the current level of earnings that you're putting in your models are not reflective of future forecasts, i.e. the base is not a sustainable or not a reliable base. And that is actually muddying the waters a lot. At the moment, it makes investing in this environment quite difficult. And part of what we need to do in the light of this sort of increased forecasting risk, if you like, is to make an assessment of what is happening at the moment that is structural and might continue to happen going forward, versus what is likely to unwind. And if it does unwind, what is the previous trajectory? Where is it going to unwind to? And you know, there's analysis you can put into that, but you know, obviously nobody has crystal balls, and so that is a particular challenge at the moment, versus a period where you've got 3 or 4 years of a steady earnings trajectory that you can just assess to see, can this continue, and make an easier, more reliable snapshot of what we think future earnings are going to be. The third one difficulty we see in the market is around the supply chain and inventory disruptions, and this has been a particular impact out of the sort of the COVID shutdowns globally, and we're seeing right across value chains, across industries, difficult or much more reduced availability of stock globally. And it can be sourced from raw materials, it can be sourced from manufacturing shutdowns, it can be sourced from freight. So, the challenge really has a number of layers. If you're an importer of whether it's goods or if it's capital or if it's raw materials, if you're an importer of that, you have to first of all go and fight now for what is globally a scarce resource. And it's at moments like that you find out where do you stand in the pecking order to be able to get your hand on what is now a finite resource. And as I said, that could be complete finished goods or it could be raw materials. Good example is which is impacting everything is the computer chip shortages, which is wreaking havoc on all things from cars to laptop computers and poker machines and all sorts of products. So even if you can get your hands on stock or raw materials, your second challenge is actually the freight and logistic effort of getting it into the country. So the cost of freight, and many of you will have seen the sort of the charts which shows freight is 3, 4, 5 times up to 10 times more expensive now than what it has been previously. And even if you're willing to pay for it, quite often you can't actually find a container to get it into the country. And then if you're able to actually have achieved both of those things about sourcing and getting it into the country, do you actually have the balance sheet to be able to pay for and to stockpile this inventory in Australia and tie up a lot of capital with inventory sitting on shores here, not actually certain as to whether you'll be able to sell it at some point. So having the balance sheet capacity to actually to commit to get this stuff in is also very difficult at the moment. So that's kind of 3 challenges, if you like, that we think is making investing quite difficult. And when we assess companies, that these are 3 metrics we're definitely looking at to say, how do we stack up on these 3 risks? And the way we do it is I've just got a few points here of how we think about it, but also maybe a few quick examples before we discuss them later on of stocks. So in terms of the low interest rate environment and the inflationary risks, we look for business models that have an element of inflation protection built into them and which have pricing power. So a good example, I'll talk about it in a moment, but Telstra has 25% of their valuation is effectively tied up in a long-term bond with the government. Essentially, it's with NBN, but backed by the government, which has a step up linked to inflation built in part of that. So if inflation does in fact run away, Telstra benefits by having that income stream also accelerate. It's a nice inflation protection element of those shares. Woolworths is a good example of a company that has strong pricing power in its value chain. At both ends, really, it has the pricing power to push back on inflation impacts from its suppliers, but also to pass on any pricing it feels it needs to do to its customers. And of course, if you're able to increase the value of each box that you sell, but sell the same number of boxes, then that's a good equation for your bottom line. So it's actually Woolworths is an example of a business which is able to benefit in an inflationary environment. And NAB I've got there as banks in general do well in a rising interest rate environment. It helps them to expand the net interest margin, which is effectively their operating margin. So making sure that we've got companies that at very least will not lose in an interest rate or an inflationary environment, but more than that, if we can find winners, those that benefit. The second sort of risk or area where we talk about forecasting area, really we protect ourselves here by making sure in the first place that let's make sure we're in defensively characterized businesses to start off with. So that is, businesses that are not going to have big volatile earnings, businesses that have been pretty solid through COVID and hopefully should be, coming out as well, and whose underlying drivers are not so cyclical, but have some sort of fundamental growth underlay that we can see, and not just defensively characterized, but also with very transparent earnings. So earnings where we can clearly see and track those drivers, removing the sort of the murkiness or the need for crystal balls. And so, you know, a number of stocks we've listed there. I mean, ResMed, sort of a healthcare, very defensively characterized. People who use those products do so because they need them. It's not a discretion. Woolworths is obviously a very defensive stock. But CSL, Ramsay Healthcare, Mirvac, really, you know, more than half of our portfolio is in what we call defensive names, and that helps a lot when you're actually making an assessment as to, you know, what does future earnings look like. And a part of this analysis, as we said before, as well, is, you know, many of our even defensive stocks have over-earned during this period, but we just make sure that we understand what we think the ongoing earnings looks like. And with defensively characterized transparent business models, we can do that much easier than we can with businesses where we're really having to lick our thumb and see which way the wind's blowing. So that's how we cope with forecasting error. The final one, supply chain inventory disruptions. You know, this is in many cases very difficult for a lot of, you know, Australian companies to handle. But again, we focus on companies that have strong balance sheets with integrated supply chains and an omni-channel capability. It helps to be a dominant player domestically and have the balance of power in your value chain. So examples here, I mean, Super Retail Group's one we talk about. Rebel Sport is it used to be top 10. I think now it's actually top 5 global customer for Nike and Asics and Adidas, etc. So that is to say, when Nike sits down and thinks about who are their main customers that they need to look at, Rebel Sport's on that table. And that's because, you know, they represent the whole of Australia, essentially, whereas a lot of other customers might be a particular player in one market, albeit it could be a bigger market of North America or Europe. The point is that Rebel Sport matters to Nike. And so during COVID, when supply got very short, Nike was actually rediverting inventory away from other parts of the world to Australia to make sure that Rebel Sport was looked after. So that's a sort of a characteristic of a business that we want to be behind. JBH is a similar story when it comes to electronics in Australia. Aristocrat is the same when it comes to getting the raw materials to make poker machines. Those suppliers want to make sure they take care of the global leader first. It's not in their interest to sort of burn those bridges for when things open up again. So the dominant player with the balance of power, but also with strong balance sheets to be able to purchase and hold inventory is the way to navigate that, and we make sure we align ourselves that way too. So what I've just described is I guess how we're looking to address some of those issues that we see at the moment. I guess the point that we wanted to make sure that we didn't want to confuse or muddy is that this represents some sort of a change in our investment approach or in our investment philosophy, and that's absolutely not the case. So we continue to use exactly the same methodology, the exactly same parameters, etc., in order to hunt opportunities and to assess our existing holdings. I guess what we would say to you is that in doing that, the outcome of that approach is now actually focusing us a lot more towards, in this environment, what we would call hard assets. And hard assets actually are very well equipped to deal with those 3 factors we've just gone through. So when people talk about hard assets, I guess, and historically my mind also would likely have gone to the likes of, infrastructure players such as Sydney Airport or Transurban or a large, REIT property manager. But hard assets for us are not just infrastructure or property plays. They're really business models that have, if you like, the power, the balance of power. And that is something that we've always spoken about in our investment approach. And that power comes from being, as I said, a key domestic player in that market. It is typically supported by long-term contractual arrangements with favorable terms with counterparties, and that often delivers pricing power. It's owning unique or scarce assets, and unique or scarce assets is not always, a large airport or a large highway. It can be superior non-trivial intellectual property. And, you know, Aristocrat's a good example of that. The IP that they have in their game design and in their game designers is a massive barrier, competitive advantage, if you like, which has really been delivering for them for some time now. Being the lowest cost producer in your category is very important. It allows you to compete harder when the screws get tightened. And having a robust business model that can adapt to change has been something that we've seen as a differentiating factor during COVID, and not just adapt to change, but to do so at scale. And, you know, to see some of your very large retailers go from, you know, large brick and mortar to within the space of 12 months having very large, substantial online businesses has been quite an effort by some of those operators. So examples we've got down here of what we think are hard assets, and we'll go through some of these in a moment, but Telstra is certainly one. Super Retail Group, Accent Group is probably a couple that you might not normally have considered, but we think actually ticks the box. Aristocrat and Credit Corp, and you know, there are more, but it is this focus on hard assets we find typically are addressing a lot of the investment concerns that we are seeing in the market at the moment. And that's where our investment thesis is really pointing us to, or that's where it's coming out at the moment. So we're now going to step onto the portfolio. I'll hand over to Anton, who'll take you through sort of how the portfolio looks at the moment. Anton.
Okay, if you look at the portfolio, if you look at the left-hand side, there are top 10 holdings. It's quite notable that, you know, in the top 6, 7, most of those are defensives, and that's the beige color there. So if you look at our defensives, it's about, as Mark mentioned, half of the portfolio, and that would include companies like Telstra, you know, which we will discuss in more detail later on. CSL Resmate, which has got huge intellectual capital that they monetize at high margins, Aristocrat and Mirvac. Then if we, you know, look at the financials, it's about 28%. We still very positive on financials, as Mark mentioned as well. A inclining yield curve is actually positive. If you look at banks, they borrow short and they lend long. The banks are highly, you know, have excess capital, and they're highly provisioned as well, you know, post-COVID. We've got Evolution Mining, and we've got resources there at 7.5% of the portfolio. And we've never had that historically, because we always maintained that we couldn't, you know, predict the spot prices or the FX, you know, the spot prices of the commodities. But if you look at our resources, it's really 3 companies. It's Evolution Mining, which is the biggest holding. Evolution Mining is the lowest cost producer of gold, and it's got an excellent management team. Then we've got Rio Tinto and Fortescue, the iron ore players. It's really the same story there. I mean, they're the lowest cost producers globally. So if you look at the big 3 Australian companies, Fortescue, Rio Tinto, BHP are the lowest cost producers, and then Vale in Brazil is 4th, and then you've got a fragmented market of higher cost producers. It was always, you know, as we said, it's always difficult to forecast the spot market, in particular for iron ore. When iron ore was 220, you know, nobody really believed that, and it wasn't reflected in share prices as well. But if we look at our holdings at about, depends on, you know, between Fortescue and Rio Tinto, because they've got different grades, but at $90 we still get a 10% yield, you know, so we still get paid. SG Fleet is a fleet management company. Mark talked about it before as well, on, you know, if you look at the supply chain disruption with microchips. So the car market is really constrained in supply, but the benefit of that is where people postpone buying new cars, you know, you can't postpone it forever. So this company is pregnant with profits going forward. And, you know, Super Retail, we'll also discuss a bit later. but that to us is also a dominant retailer together with Accent Group, where they actually dominate and have the pricing power, not only with suppliers, but also with landlords. So if you look at the top 10 holdings, the cumulative weight is about 50% in the fund. And we've always said we benchmark unaware, and you can see that same holding within the ASX 300 to 16%. So it's quite clear that we benchmark unaware. We always get asked, what's your view on the market? How do you think the portfolio will do in the next 12 months? We don't really know, to be quite honest, because who knows what the market is going to do. But the way we look at companies, we get an after-tax cash earnings yield of 7%. And that's for the total portfolio, the equity portfolio. So if all things being equal and nothing really happens, that 7% should actually accrue to us over the next 12 months. So, and then if you look at the dividend payout ratio of, between 70 and 80%, you will get that paid back in dividends as well. It's quite important to realize that this 7% is actually before any potential capital return. So Mark mentioned as well, if you look at all our companies, actually in our portfolio, there's not one company who's highly indebted. In fact, most of the companies are cash positive or very little debt. And, when we talk to management teams, like over the past 12 months in reporting season, we always challenge them about lazy balance sheets. Where, why did you pay out higher dividends, or, just returning to shareholders via buybacks? So they would tell us that firstly, with the uncertainty in COVID, as we've discussed, it's really beneficial to have a strong balance sheet because it gives you optionality to accumulate your inventory, especially where you've got major disruptions. If you look at the Accent One, for instance, there's massive disruption in Vietnam with shoes. They've got a balance sheet to take it, the inventory onto a balance sheet, and that's applicable to most of the companies in our portfolio. So we would envisage that, either, in a post-COVID, a more normal environment, that companies can either do M&A, they can do buybacks, or they can return higher dividends, which would enhance our capital returns. A good example, it's a smaller holding in a fund, is Ample, for instance. They've made an offer to buy a company in New Zealand, a fuel retailer, Z Energy, but they've got an optionality. If they don't buy that, they'll return capital by 600 mil. So it's really, companies with strong balance sheet are really in a good place. If I look at the right-hand side, the sector exposures, as I said, defensives is really half of the portfolio. Consumer discretionary is mainly, super retail, Accent One, and then you've got unfortunately a smaller position in the Flight Centre that's done quite well. Resources I've covered. Cash is at 6%. I think the last time we spoke to you, it was at 9%. And as we indicated, cash is actually very problematic in the sense that you get no return on it. Our cash is mostly just in cash, not in term deposits, because we prefer to have the liquidity, to deploy that when the opportunity arises. Our put option exposure at the end of August was about 4%, the nominal value. That has gone up to about 9%, just under 10% with the recent volatility we're at. So, the puts that we buy are, 6 months puts, 5% out of the money, and it's quite a nice delta on that. So that gives us the protection on the downside, not just from a monetary point of view, but also, as I said before, it really helps with that psychological wholeness that, when things are really tough, you have the conviction to deploy the capital. So, okay, we'll go over to discussing some companies. Mark will do Telstra, and I'll do Ryman Healthcare and Accent Group, and then we'll go over into Q&A.
Great. So thanks, Anton. We often find when we talk to people that they glaze over a lot of the first half of the presentation, and then when we start talking stocks, everybody gets a little bit more interested. So hopefully that's the case. Hopefully we can finish off with a few interesting comments on some stocks alone. We want to do this for two reasons. We want to, first of all, take you through obviously some features of our investment thesis in these companies, but also in doing so, talk you through the way that we approach and the way that we look at these companies, sort of reflecting our investment approach, if you like. So the first thing we do whenever we look at a stock is to sort of say, all right, what are we buying? This is where that transparency element comes into it. We need to be able to answer this question very easily and accurately. So with Telstra, for every dollar you put into Telstra, you're effectively getting 65% of that value is tied up in the mobile business. So almost 2/3 in their mobile business. 20% is tied up in the recurring NBN income stream. So this is effectively I think that there's about 30 odd years remaining on this contracted income stream, which will increase at a measure linked to inflation over that time frame. So it is effectively as close to a government bond that you can get, except this one's paying sort of around about the 6-7% mark, depending on sort of what you back out for the other components. So importantly there, when we look at that, we've got 85% of our investment in Telstra is the mobile business and this recurring NBN stream. 15% of the business we have tied up in some other stuff. And I don't mean to trivialize the other stuff, because there are some big businesses in there, and certainly we focus on it. But from a materiality perspective, obviously it's the mobile business and it's that recurring NBN stream that we really need to get comfortable with and know that we want to own those particular assets. It's important to note that's kind of a split by operating division, if you like. Within all of those, or behind all of those, is Telstra's infrastructure assets. And those infrastructure assets are, some of them are specific to a particular division. So for example, the towers, the infrastructure are specific to the mobile business. But you've also got the network of fiber and ducts and exchanges and backhaul. There's a lot of other infrastructure that sits behind all of those divisions, which really is a very unique asset nationally. Telstra is the only one that has obviously the national footprint with this telco infrastructure. But they've also, even where there is duplication with some of the other operators, Telstra's is more superior, particularly on the mobile side. And this is relevant for a couple of reasons. Telstra identified this a few years ago that they've got this particularly attractive infrastructure, but it wasn't obviously being recognized by investors. So they actually reorganized their business to have a separate, what they call InfraCo, where they separated out the infrastructure assets and effectively attached an earnings to them, so that investors could actually see, look, there is this amount of infrastructure and it is generating this earnings. And that has been very good from a transparency point of view, but also many of you would know recently from a monetization point of view, because they're actually able to draw interest at very high valuation levels to come in and be a partner with the tower business. So they sold a 49% stake in their tower business, realizing just under $3 billion for that, which is a great outcome, because you're able to capitalize on some very high valuations, but retain control of that business, of those assets via Telstra's going forward 51% stake. And they're looking to do the same with the remaining infrastructure assets that they have, which, by the way, is about 5 or 6 times the size of the tower business that they've just monetized as well. So there's much more significant monetization to come, without having to necessarily give up control of those assets for the benefit of Telstra shareholders. So going back to what I said before, we've 85% of our valuation is tied up in a mobile business and the recurring NBN income stream. Are those good businesses? Is the next question we ask. And there's a lot of different criteria as to what makes a good business. But when we look at the mobile business, we look at a business that comprises substantial non-trivial infrastructure, but also the best mobile network in Australia. which they are able to monetize via a 25% price premium on the rest of the market. And they're able to maintain that premium. It's not just a flash in the pan at any point in time. It's something that they've been able to maintain. So it is obviously valued by consumers in Australia. Mobile data is and has proven to be a very important product, if you like, in people's purchasing. When we look at the elasticity of or the defensiveness of different categories, you know, mobile data is right up there in terms of with food and water and shelter by just about every analysis that is done. You sacrifice a lot of things before you sacrifice your access to data. And so to be the #1 and lowest cost producer of that data in the country is a great business. Telstra has quite a head start in the rollout of 5G in Australia. So and this is from a physical network infrastructure perspective, they're about 18 months ahead of Optus, which is the next nearest competitor in terms of 5G capability. So that's not just time, but that's also money investments that Optus needs to spend in order to catch up as well. So that material advantage obviously makes that a very good business. And when we look at the recurring NBN stream, as I said, if someone offered you effectively a government bond paying you quarterly with a 12-month step up linked to inflation for the next 30 years at around about 6 to 7% yield, you'd look at long-term bonds at the moment in this country of, you know, maybe closer to 1, and you'd conclude that looks like a pretty good deal to me. We think within Telstra, it's a very undervalued component of Telstra's overall valuation. So the next question we would ask ourselves is management competent? And when we look at this for Telstra, we probably, 4 years ago, we might have had less conviction on this, but that conviction has certainly grown very strongly over the last 3 or 4 years. So they've successfully executed on their T22 plan, which was bold. It involves a substantial cost out program. It involved re-engineering their entire product portfolio. It involved re-engineering their entire technical capabilities, and many other things, which, for a company the size of Telstra was not just very ambitious to take on, but very high execution risk, whilst having the full spotlight of the media, the government, the NBN, and shareholders on, the whole time. They've come out of that, I would argue, with glowing colours. And it's interesting now, the investor day they gave about a few weeks ago, the narrative has shifted substantially from, an existential discussion, or at very least, can they maintain the dividend, to now one being a discussion and a narrative of growth, now that they have the platform to do so. And I think that reflects on management's competency in the meantime. So the final question we say is, can we acquire it at the right price? There are a lot of very good businesses out there which we would love to own, but which we cannot yet acquire at the right price. We were fortunate enough to have gotten a number of opportunities at prices much lower than this. It's been a very good performer for the fund over the last couple of years. First of all, I might add quite a counter-consensual position that we took, and I guess over the last 6 to 9 months, it's been a little bit more of a popular holding. But even after the strong performance it's had, even today, we can still achieve an after-tax cash earnings yield of about 7.5% today, rising to 9% over the next couple of years, with visibility about how that can grow further, which for an asset like Telstra, those we think are some pretty attractive yields. It's also currently paying at the moment a prospective dividend yield of about 4%. And as we have argued with management for some time, they effectively pay the dividend as a percentage of their earnings, but their cash flow is growing much faster than what their earnings is. And so if you actually have a look, and this narrative has been picked up a little bit more by analysts in recent months, if you actually analyze Telstra on a cash flow basis as opposed to a P&L basis, you actually see that they've got the capability to pay higher dividends and to get a growth trajectory, sort of in the very near term for that dividend. And that's obviously key for many Telstra shareholders. So So we think we've got a good thing here where we've got good transparency over what we're buying. We know how much we're getting for each component. We're comfortable that the key components are good businesses. We've got a competent management that has proven themselves with a good track record, and we can acquire it at the right price. And so for us, there's a reason why this stock is the largest holding in the portfolio. And even though it has had, it has enjoyed its largest gains, you could argue over the last 18 months, we still think it's a good position for the fund. So that's a run through Telstra, and I'm happy to take more questions on that afterwards. But I'll hand over to Anton beforehand to maybe take through one or two more.
The first company is Ryman Healthcare. This is a New Zealand-based, integrated aged care and retirement village company. They've started a business in Victoria, Australia. But if you look at the company, it's really, 80% of plus minus is retirement villages in New Zealand, and 20% is a land bank. Why I like this company and why it's so fascinating is that, this company has since IPOs never raised capital, because it's got this unique business model, and that's really applicable, to most of the aged care guys, is that they recycle capital. And the way they do that is they build villages, they create double-digit development margins on that, they get occupancy. So you as a resident buy the right, the occupancy right, and then, when you're not there anymore, you on-sell it, and that way they recycle capital. And in a process, then Ryman earns a deferred management fee as well. So this is quite unique. Ryman is the one company that is really the gold standard in the way that they've actually integrated it. So if you look at, and some other aged care operators, they very much focused on the financial engineering of the business model, i.e. the recycling of capital, whereas Ryman were the first guys to integrate, the care, high care, so that's dementia wards, right through to independent, living units. So you actually have got this whole, pipeline of people. If you think about it, when you want to make the decision to go into aged care, you might start out in an independent living. As you get older, you move into a service department, and then eventually you might move into frail care. And that is a massive value proposition for people. So it's not just always, the decision is not really always monetary. It's, will I be looked after, in my old age? So we can ask, is management competent? They've consistently showed that they can, earn double-digit development margins. Most of the development is actually done in-house, and they outsource some of it, but they've really perfected the cookie cutter way of building units. And that is not non-trivial. A lot of other guys have actually, faulted on that. Then the occupancy rate has been, it oscillates between 97 and 98% over time, which just shows you the attractiveness of the actual product. Then a very important point is on resale. So, this asset base, you build a village, but it's actually linked to the property sector in each of these catchment areas of each village. So let's say the average house price in a certain catchment area is $1 million, then Ryman would build an independent living unit at a 25 to 30% discount to that. So you've got that margin of safety. That's really important. You've got a margin of safety that they don't overprice, but you also have this appreciation over time. So if I buy the unit, I sell it back to Ryman in 5 years' time, they'll resale it. at a higher price, you know, which is linked to the property price. So you've got an inbuilt sort of inflation protector there. So if we look at, you know, retirement villages, is it a good business? As I said, I think this is, you know, you've got a massive tailwind, especially in New Zealand and in Australia. The population gets older. And I think COVID is actually, you know, from what we spoke to quite a few of these aged care operators, I think COVID has actually enhanced the brands, you know, and just the value proposition as well, you know, because, you know, we've had sort of anecdotal evidence, you know, you're 80 years old, you live in your house, you get COVID, you know, you can't go out to go shopping, etc., etc., and it just becomes so attractive to actually go into a more protected environment where you looked after. Then the last question really is, can you buy it at the right price? So I have to say, Ryman has always been perceived as an expensive company. So we are, you know, patient on this, but, you know, recently the MD resigned due to personal, you know, reasons. We double checked with him. We spoke to the chairman, and, you know, the company at the end of the day is always bigger than the MD, but it actually gave us the opportunity to accumulate quite a substantial stake in that. And we've done detailed work on evaluation as well, and we actually accumulated our stake at less than 20% of what we, you know, calculated to be the present value of the net tangible asset value. So that we're very comfortable with this holding. It's just under 4% of the portfolio. As I said, it's defensive, you know, and it's really backed by solid assets. I think we're sort of running out of time now. Adam, I think we'll pass over for Q&A, you know, and we're happy to discuss any of the other stocks in the pack as well.
I think that we have already gone over time, so I'll probably skip Q&A this morning and we'll respond to your questions directly. Gentlemen, thank you very much. It was a very comprehensive sort of an update, and I didn't want to stop you because I think there was great value in the detail of the discussion. Our next webinar in the series will take place at the same time next week, so if you haven't yet registered, please do so on our website. Thank you very much for joining us. If you have any other questions, please get in touch directly. We'd love to hear from you.